Today, I want to share with you 3 common tax traps relating to long-term capital gains for folks age 65 plus. Let's get going. Most people understand that long-term capital gains get special treatment in the tax code. But what they don't understand is the act of taking a capital gain pushes your gross income up. This can impact your Medicare premiums, it can impact how much of your Social Security is taxable, and finally, it can impact whether or not you get some of these special tax deductions, some of which were just passed in this 2025 tax bill. We're going to break them down one by one. Let's start by talking about Medicare. So Medicare premiums are based on your gross income, or a calculation of basically all your income sources added together. The issue, of course, is capital gains is part of your gross income. So if you take a big gain, it's going to push your income up, and this can affect how much you pay for Medicare. For example, I'm going to throw the table or a table up on the screen for the figures relating to 2025, the year I'm recording this. You can see the associated Medicare premiums out here in the right-hand column versus the various income thresholds for individual tax filers in the very left here and joint filers in the center. So as your income rises, so too do your Medicare premiums. And this can be an unpleasant surprise for folks, especially those who are kind of right on the edge of these thresholds. Even a small capital gain, it only takes $1 to push you over any one of these income thresholds can result in a premium jump years down the road. The big unpleasant surprises, of course, are, if you take a large, say 6-figure long-term capital gain, you might find yourself at the lowest premium level here, and then a couple years down the road, because of the gain you took, you might be up here in some of these top brackets. Okay, the good news is it only lasts for 1 calendar year, but nonetheless, this is something that people often forget about. Next, let's talk about how long-term capital gains can affect the taxation of your Social Security benefits. Now, I'm going to try to keep this pretty high level, but if you're looking for more, I did an entire video on this subject. I'm going to link it in the upper right-hand corner of your screen, so if you want some additional details and examples beyond what we're going to discuss here today, check out that video. Now, to understand this tax trap that exists around long-term capital gains and Social Security, here's really what you need to know. Even though long-term capital gains get special treatment in the tax code, they still affect how much of someone's Social Security benefits are going to be taxable. Let me show you an example on a tax return. Now, real briefly, before we look at that sample tax return, I want you to take a peek at the long-term capital gains tax rates for 2025. So you can see in the table, the tax rates are in the center with the income thresholds for individuals on the left and joint filers on the right. Our example is going to be a couple, so you can see the 0% capital gains tax rate goes up to $96,700. But notably, this is for taxable income, okay, which is a combined number. This will make more sense when we look at the tax return. Now, our example couple, we're going to call them Bob and Mary. They're both over age 65. I'll throw the tax return up on the screen. Here is their baseline income. Okay, for 2025, we're going to say they have $5,000 worth of interest income. They've got $24,000 they've withdrawn out of their pre-tax IRAs. And most notably on line 6, here's their Social Security benefits, $48,000 of combined benefits, but only $13,650 of them are taxable given their combination of income here. Okay, now the good news for them is we add all these things up, $42,650, they have enough tax deductions to wipe out their income. So their taxable income in this baseline is 0. Now, naturally, you could see how people could get into some trouble here. They're thinking, oh, hey, our taxable income's calculating out to 0, so we can take a big long-term capital gain, maybe even up to that $96,700 mark and pay no income tax. Well, I'm going to show you how that interplays with Social Security and can lead them right into the tax trap. All right, I've adjusted the tax return. We'll say Bob and Mary thought they're going to be clever and they're going to take a $95,000 capital gain. They're going to try to stay just under that rate threshold that we looked at previously. But let's see how the numbers actually changed. So here's the tax return, and interest income, IRA distributions, those are staying the same. Let's jump down here to line 7. This is the capital gain they're taking for $95,000. But most notably, look at line 6, their Social Security, $48,000. Look how much is getting taxed now. They're hitting that maximum of 85%. Okay, and this is why, if we drop down to the bottom line here, a taxable income number, which, if you remember previously, was 0, by adding a capital gain here and pushing their Social Security into tax territory, they're ending up with a taxable income number now of nearly $120,000 and an unexpected tax bill of about $6,000. So to wrap up the discussion on this second tax trap around long-term capital gains, essentially anyone who's drawn Social Security has to remember that any capital gain they take will push their Social Security benefits more into taxable territory if they haven't already reached that 85% maximum. So you've got to be thinking about this when you're doing your tax planning. Now, the last tax trap I want to touch on today is the potential for losing out on the new senior bonus deduction, which was part of the tax law passed in the middle of 2025. Just as a recap, this additional tax deduction was for folks age 65 and above. For individuals, as long as your income was below $75,000, you get a full $6,000 deduction. For couples, it's $150,000 or below. You each get an additional $6,000 deduction. Once your income exceeds those thresholds, this deduction starts to phase out and is ultimately eliminated. Let me show you an example on a tax return. Now, let's just kind of continue our example with Bob and Mary. I'm going to change some of the figures. So here's a hypothetical tax return for them. We're going to push their income up a bit here. We'll say they have taxable interest of $5,000. They're pulling $5,000 a month out of some IRAs, which is $60,000 a year, $30,000 pension, and they got a combined nearly $60,000 of Social Security benefits, of which they're hitting the max already. They're already 85% taxable here. So their total gross income right now is $145,000. Okay, so they are just below that $150,000 for which that bonus deduction starts to phase out. If we go down here in line 13B, here is that bonus deduction I mentioned. Because they're both 65 plus, they each get an additional $6,000 to bring their income level down. Now, I'm basically just going to change the tax return here, add on a capital gain, and show you how they start to lose that as their income rises. All right, let's change our assumptions and assume that Bob and Mary, in addition to the base income we looked at, also ended up with a $50,000 long-term capital gain. So let's see how that impacts that senior bonus deduction. So here's the tax return. Again, everything up here is staying the same except for line 7. Now we got that additional $50,000 worth of income. We drop down here to line 13B. This is where that $12,000 combined senior deduction was. Well, as you can see, it's shrinking down because they're in the phase out of that deduction. They've lost $5,400 worth of that. The bottom line is, when you lose a deduction, that means you're paying tax on more of your income. So if you just kind of do some rough math on this, this ends up costing them roughly an extra $1,200 in federal income tax. So the capital gain is creating tax not only on the capital gain, but it's also, while they're in the phase out for the senior deduction, which for married couples is between $150,000 and $250,000 of gross income. While they're in that, not only are they paying any tax on that capital gain, they're also effectively paying more tax on their other income because they're losing that deduction. So that is a tax trap as it relates to this new senior deduction. Well, as you can see, once you hit 65, there's definitely some other things you got to be thinking about as it relates to long-term capital gains. Sometimes there's strategies and ways to avoid some of these tax traps. Other times there's not. But my objective here today is just to help people understand what's going on so they can plan for them in advance and don't end up with an unpleasant surprise when they ultimately file their tax return. If you got any questions, please drop those in the comment section. I do try to answer them. You can also check out my website if you're looking for more information about me or the firm. As always, thanks for watching. I hope we'll see you in the next one.